All right, there we go. My bad, y'all. My bad. They're starting to silence me, guys. I'm joking. But as you can see, got my voice back just a little bit. I'm not supposed to be on stream. I'm not supposed to be talking. Um, am I still muted? Give me a second. Better? Okay. So yeah, I kind of got my voice back a little bit. It kind of comes in waves. It's like kind of hit or miss a little bit. It does hurt still a little. But guys, it's FOMC day. It's interest rate cut day. This is a pivotal moment here in the United States. This could be a pivotal moment for crypto. And so because of that, I was like, I don't care what my doctor says. I'm going to make a video. And if this delays me getting my voice back for 2 days, it is what it is. At least I got the content out for you guys. So what I wanted to do is the Federal Reserve meeting starts in approximately 8 minutes. So what I wanted to do really quickly is I wanted to go over the cuts that we just saw announced. Then we're going to watch the meeting together. And then afterwards, I'm going to tell you my exact strategy of what I'm doing right now. And then, yeah, I'll go over maybe a little bit of charting. It really just depends. I probably will only have sound for like 20, 30 minutes or so. So this isn't going to last too long. But I had to make a video. I don't know. I couldn't help it. So yeah, so that's kind of the game plan. I do have a bit of a presentation put together, just to kind of help me go through this. Okay. Help me kind of guide through it. So let me just read this to you guys real quick. And yeah, cause I know I might be a little bit quiet. But I'm doing my best. Okay. So yeah, so just a quick reminder, I was diagnosed with laryngitis. It's just an infection that's in my vocal cords right now, so it's really hard to talk and it kind of hurts a little bit. But you guys know me, I'm not leaving you all without content, so I wanted to still hop on stream now that the Fed has officially cut interest rates and talk about why this is so important and watch the conference together. Now, before we talk about the conference, I just want to remind you why the Fed cutting rates is so important. Okay, let's talk about this first. So the reason why them cutting rates is so important is because cutting rates equals people and businesses having more capital and easier access to capital. Loans go down, interest rates go down, people stuff more cash aside, savings rates go up, all of these things, right? Now, as a result of more and easier access to capital, people in a consumeristic and investmental based society, a capitalist society especially, will invest more and they will spend more money. And as they invest more money and they spend more money, asset prices in the stock market, the crypto market, and the real estate market oftentimes will go up. Okay. So because of this, the easiest way to think about it is cutting rates gives people more money that they'll spend and invest that'll oftentimes over time give asset prices higher valuations. So, sorry guys. 1 second. So clearly, this is a good thing for crypto, stocks, and the overall economy in general, but over the long term. But don't forget, the market isn't all sunshine and rainbows. Even when it should go up, it can still go down. But we will talk about preparing for that volatility after the speech, okay? So what I want you all to understand is that, listen, just because interest rates are going down and they're being cut, it does not mean that things just go straight up. Remember, they're cutting rates for a reason. They're cutting rates because the economy is struggling. People don't have money. People are not getting jobs. Unemployment is climbing. Inflation is still high. So the economy and the global economy is still in a weird spot and people don't have a lot of money. This is something that will have an effect over the long term. This could take 6 months to a year in order for it to really start impacting the market. So this is not an immediate thing, and it doesn't mean that things always will just go up. It is a good thing overall for the macro vision, and you have to be able to look at it with that long-term vision. Like if you're mad right now because the crypto market's not pumping, you're just looking at this completely wrong. And I've told you all, I've always said this, like, listen, yeah, a dump after this could happen, a pump, it doesn't matter. It's not about what happens right now. It's the door of opportunity that is opening. It's the door of opportunity that's opening right now for the crypto market in the long term, okay? And that's where the true value is. So even if the market dumps today, it doesn't mean that this is a nothing burger. It doesn't mean that this is unimportant. This is incredibly important because it opens up a door of opportunity for the market, for asset classes to go up in value over time. And that's what we're looking for here, okay? That's what we're looking for. And so with that in mind, this is still a very big thing. It's a good thing, okay? So now, regarding the speech in the conference, which starts in 4 minutes. Okay. This is a very important conference because Jerome Powell's tone and words about the future will have a massive impact on the rest of this year in stocks and crypto. And so, for example, if he comes out and he's very optimistic about the future, the market is going to price that in and assume that maybe some interest rates will come in. So, for example, if he comes out sounding optimistic that these rate cuts are a good thing and will bring life back to the economy, we'll probably rally a ton over the next coming months with some manipulation along the way, right? But if he comes out sounding hawkish, aka pessimistic, about the future and unsure if rate cuts will continue, then the market may very well remain kind of boring and dead as it will have nothing to price in for the future, right? So the market is something that prices things in advance. The market priced in this 25%, this 25 BPS cut already, which is the reason it's not going too crazy right now. It knew this was going to happen. And so what we're doing now is we need to look into the future, and what Jerome Powell says today is going to have a massive impact on the future, right? And so that's why it's so important to be listening to what he says today, and we need to kind of see like how he says it, what he does, and all that stuff. Now, after the speech, I'll write out some basic thoughts and notes that I took during the speech and what I think is going to happen as a result of what he said. So make sure you stick around after the speech, and then I will give you all my buy targets and sell targets for moving forward. Okay. Before we get into that, guys, shameless plug. Don't forget, you can get up to $10,000 in bonuses and rewards if you sign up to BTCC using my link today. Just because I got a little bit of a throat infection does not mean I'm not going to plug something. So check out the link down below to that. But without further ado, the speech does start in just 3 minutes. So we're going to go ahead and get prepared for that. Let me go ahead and get that shared up for you. Give me one quick second. And again, sorry guys, I know this sounds weird and looks weird. It's not a typical live stream for me. I'm trying my best. Only slept like 3 hours last night. I'm not going to lie. It's just very uncomfortable trying to like respirate and shit when your throat's all swollen and stuff. But we're going to keep it going for you guys one way or another. I'm here through the good, the bad, and the fucking ugly, no matter what. So let's get this going. Here we go. Alrighty. There we go. There we go. All right. Sounds good. So this starts in just a couple of minutes here. So until then, listen, I'm going to throw on some tunes and we can just kind of vibe out for a second. And then, yeah, we can go from there. What's this? I like this little tune here. But yeah, so I hope you all are doing good. I know it's obviously a bit of a weird market. Well, after this, I'll show you guys my buy targets. I'm going to show y'all my portfolio. So stick around for that if you're interested. I'm not going to be showing exact dollar amounts because I feel weird about doing that. But I will show you guys my portfolio. I will show you how my portfolio is broken down right now because a lot of you have asked, and I feel like it's okay I'm kind of, you know, exposing my crypto portfolio, I guess. So I am going to talk to you all a little bit about that. And yeah, so it should be all good. But yeah, so yeah, we'll do that after. But for now, primary focus is just Jerome Powell, whatever, you know, however he sounds and all that stuff. That's going to be very important. So I'll take some notes during it, and then I'll share those notes with you as best as I possibly can. And yeah. Hey, yo, what? Yo, y'all are nuts, bro. Yeah, no, I feel like I'm doing some like crypto ASMR, but this is literally as loud as I can get. Like if I start trying to raise my voice, it just does not come out, and it really fucking makes me angry. All right, anyway. Hey, can y'all hear this? Well, nothing's happening right now. Hey, whenever he starts talking, can somebody put in the chat if they can hear it? Can y'all hear that?
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level.
Earl, what the fuck?
Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks, which the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
So just looking at the SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low, it's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address.
W question.
How do you see
question.
that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now
literally
perhaps
said
more
earlier
than
that it was because of
in
immigration,
supply,
which is like
and
a
we know
hit
that
at
because
Trump.
the unemployment rate has ticked up. So, that's what I meant by that.
Like a follow-up, every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's, that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now. And people they're making their arguments, and we're having a great discussion around these challenging issues. So,
Do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minority unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
What a question.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in. And it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and, business investment. So, we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates. And that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up, during the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
You know, forecasting is very difficult even in placid times. And as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. You know, the level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
All right. Okay. Yeah, that last 20 minutes was kind of rough. I ain't gonna lie. Anybody who just joined the stream, just to kind of give you a little bit of context, I have an infection in my vocal cords, which means I can't really speak that well. So if it sounds kind of weird, it's because of that, but I'm going to continue to try to do my best. So what I want to do going forward is we are going to do a quick recap of what the interest rate cuts mean and whether I think they're a good thing. And I took some notes on his speech that I'm going to share with you guys. And then what I'm going to do is I'm going to tell you my exact strategy going into the rest of this week, month-ish. And then, yeah, we'll probably close it off there. I'm not really going to be able to do a Q&A just because it hurts really bad when I talk. It feels like I have strep throat every time I talk. But we're here for the content, so fuck yeah, let's rock and roll. So all in all, there was a 25 BPS cut, 0.25%. It is a good thing, in my opinion, because it means they are now willing to start taking steps in the right direction to get the economy back in a better place. They're taking some of the constraints off of the economy that have been put on the economy for quite some time, and it's obviously caused people like me and people like you to see increased prices. It's just harder to get access to mortgages. It's not good overall, right? And the economy's in a bit of a harder place because they were trying to combat inflation. But now that we are starting to see unemployment climbing and employment as a whole in a much worse spot than it was in, the Fed is willing to start taking some steps in the right direction to start loosening some of those constraints on the economy, which all in all should put more money in the hands of investors and businesses. Now, I'm under the belief that this is intrinsically a good thing for the long term because it oftentimes does show in a capitalistic society like we're in that whenever, and especially a consumeristic society, that when people are given more money, right? And not literally given money like a stimulus check, but let's say you can get a car loan for less money per month than you could a month ago. Now you have more money in your pocket. People will oftentimes either spend that money, invest that money, or save that money. Much more likely that they spend that money, but some people will also invest it and save it. And what we've kind of come to realize is that as these consumers and as the everyday person goes in and they invest that money, save that money, or spend that money, that does typically have a positive impact on asset classes like the stock market, the crypto market, the real estate market, bond markets, precious metals, et cetera. And so historically speaking, what will happen is that in a period in time in which the Fed is cutting interest rates, we will see assets rise in price over a long period of time from that point forward. Now, it doesn't mean that it's going to be immediate. And oftentimes you do have to factor in the fact that they're cutting rates for a reason. And they're cutting rates right now because the economy is not in a good place. So that does, of course, imply that we are in a rough spot still. And it's going to take some time for these adjustments to actually cause changes here in the world. But this is a step in the right direction. And it does open up a new door of opportunity here for the crypto market that it's not had for a very long time. Now, we are not in a full season of quantitative easing. They are, of course, still reducing their balance sheets, and that is technically quantitative tightening. But all in all, I don't believe that that is kind of impactful enough to mitigate the gains or the growth to a substantial degree. I do think we are still in a position in which this is a net positive for the economy. It's a net positive for business. It's a net positive for people like you. It's a net positive for people like me. And so all in all, I do think that this is a positive and a beneficial thing here for, give me one second. Oh, this shit hurts, boys. I do think overall it's a net positive for the, people in general. Okay. So yeah, I did word that weird, didn't I? But shout out to you, AJ Crypto. All love, homie. All love. Appreciate it, homie. So let's kind of go over some quick notes that I took from his speech just now, because again, his speech is going to kind of open up the window of the future, right? Like we're going to be able to get a good understanding of what is coming in the future based off of what he just said. So let me kind of quickly go through some notes that I took. So he said that the downside risks of employment have risen. They're reducing holding and security, so this is still a form of quantitative tightening. The employment market is slowing unusually. The long-term 2% inflation remains in sight, and I'm going to summarize all this in a second. Situation remains challenging, balancing employment and inflation. They are taking steps towards a more neutral stance and are trying to get ahead of bad employment turn. They need to keep monitoring the incoming data to see how to shift the balance, but they are expecting to reduce rates even further based on current projections, much lower than the previous June expectations, which is the most important thing in my brain. So I'm going to go ahead and I'm going to make this green. I'll come back to that in a second. Okay, so a few more notes. A larger than 25 BPS cut would only happen if policy is out of place and needs to move very quickly, and they don't feel like that is close to necessary right now. So I do think that is going to stop this bullshit of people thinking 50 BPSs are coming. There was very minimal support for a 50 BPS cut, and there is expected to not be as much unless something dramatic happens. Because truth be told, nothing has really changed with anything other than employment, and they need to structure properly to adjust to that risk. In terms of inflation, if prices do move up, it is mostly due to tariffs increasing, like an increase due to tariffs, but they do think that is like a one-time thing, and they don't think that is going to be like continuous month-over-month, quarter-over-quarter, year-over-year growth. So they'll keep an eye on inflation, but they're not super scared of it right now. They're more focused on employment and shifting into a more neutral standpoint to be able to monitor and control that kind of depreciation of the employment market that we're currently seeing. The vast majority of their focus is on the labor market now. So it does seem like the majority of their concerns whenever it comes to the inflation situation are kind of mitigated right now. Which is a good thing. But they're now focused on employment. And if employment does continue to show us like some negative numbers and stuff, then it is very likely they will continue to cut interest rates in order to mitigate that. Now, they're not saying that they are going to continue to cut it by another 100 BPS or 200 BPS or whatever it may be. They're more saying they're going to keep adjusting to the market. So if things continue to get a little bit worse, they'll continue to reduce rates. If things kind of chill out, they'll probably pause. And we're in a situation right now where they are expecting to have to cut more, and he kind of did imply that, right? So he wouldn't come out and just say it, but you could definitely hear in his voice that he was expecting that they would have to cut more. And current median projections are that they could get down into anywhere like the 3.5s, 3.75s this year, which could imply that we could have 25, 50, 75 BPS more in cuts coming over the next like say 3 to 4 months. So it is obviously a very touch and go market. There's a lot of things happening, a lot of changes, especially macroeconomically, geopolitically. So truth be told, there's a lot happening right now. And so you can't really go and say for sure what they're going to do, but it definitely does seem to me like there are going to be continued interest rate cuts over the next, say, 6 to 18 months. And I do think all in all, this is again going to put the environment, the economy and investors, consumers in a better situation. I think more people in general will have more money. And because of that, I do think it's a net positive for crypto. Now, what happens in the meantime, no one really knows. But I don't particularly see a reason as to why the market would crash. I don't see a reason why it would dump, right? Because you need to think about the reason it moved upwards, okay? The two primary reasons as to why the crypto market moved upwards over the last, say, 6 months is because of expectations of interest rate cuts and institutional investment. The institutions are still in. They're not scared. They're not scared of this in the slightest. And interest rates are being cut. And so the two primary catalysts that got us here are still effective. And so if people were going to take profits, they would have taken profits. If people were going to sell, they would have sold already. I don't particularly see a reason as to why the market would say fall and Bitcoin would go to like $80,000. I just don't personally see that happening. So I'm not expecting a massive 30-40% sell-off, but there definitely could be some sort of like sideways movement and continuation towards the downside in the short to midterm before opening up to the long term. So the primary reason I think that would be the case is simply because of manipulation. I don't really think the market has a reason to move in either direction. I think, truth be told, if we are going to price in, I think if we are going to price in future expectations for the economy, we are very likely going to see interest rates cut in the future, which should just be a better thing for the economy. So I do personally believe it would actually make sense for the crypto market and the stock market to continuously climb upwards, especially the stock market, because it's a very direct correlation that we know is going to happen. People are going to have more money. People are going to spend that money because that's what we do here in America, right? And that is directly going to go into the pocket of these massive companies like an Apple, for example, right? And so I think there's a direct correlation as to why the stock market should pump. I think there's a somewhat indirect correlation as to why the crypto market should go up. And so knowing that, I think I do personally have a more bias towards the upside over the next like 6 to 16, 18 months because of those things. But I am aware that in the short and the midterm, there is very likely going to be pullbacks and there's manipulation and there's the fuckery and bullshit that comes with this crypto market that we'll have to deal with. Okay. And so in my brain, I think even in the short to midterm, if the market does dump, it's only doing that with the sole intention to rinse retail investors out before it does open to the top side. I do still think that we are going to see growth. I think we're going to see pumps. I think we're going to see gains in all-time highs, not only for Bitcoin, but for most major positions as well. And so overall, I am still under the belief that this is a net positive. I think it's a good thing. And I do think this is going to lead us to some more gains later in the future. Okay. So with that in mind, my current game plan is to continue to contrarian trade. So what is contrarian trading? Here we go. Sorry, let me brush through this. So remember, my current strategy is to contrarian trade this market for the next few weeks and maybe even months. So this means that I'm going fully against the grain of the market with my buys and sells. So for example, if the market dumps, that's what I'm going to buy. If the market pumps, I'm going to sell. Now, I might do some small leverage trades, but not many because this is a very emotional time, which will trigger a lot of manipulation, and I don't want to fuck around in the fuck around. I'm just going to mind my business and do my long-term buying, okay? So my plans for implementing is this. In my top 4 bags, which is... Okay. Sorry, guys. So... my top 4 bags are Bitcoin, ETH, Solana, and XRP. I'm going to set specific buy targets and sell targets. And then for my medium and smaller bags, I will simply DCA in if they go to sub 30 on the 4-hour RSI, which I'll explain in a second. And I will DSA out, or dollar cost average out, if DCA out if they go to above the 70 on the 4-hour RSI, which I'll show you guys in a second again. Okay. Now, the reason why I've put this exact plan in place is because this is going to allow me to only focus on my big high conviction bags, but still have a plan in place for my smaller bags. I personally just tend to try to prioritize my big bags during emotional times as it helps keep me grounded. So if the market goes up and down and it's being all crazy, I'd rather just focus on my big bags because that's where my high conviction is at. And it allows me to stay kind of grounded into the market and not get too freaked out. Now, I did tell you guys I would show you my portfolio. This isn't something that I've showed on my YouTube channel publicly in years, but this is my current portfolio. I did do a huge consolidation. I sold an absolute ton. Any of my underperformers, any of the ones that have just simply not performed very well, I have rotated those positions into bigger positions, lowered my dollar cost average in some of my more favorite ones. And yeah, so this is my current portfolio. It is majoritively made up of Bitcoin, as you can see. My Bitcoin position is about 65% of my total portfolio as a whole. These are my profit percentages, unrealized. So what you can see is Bitcoin. My Bitcoin position is up 250%, average buy-in of 33,000. ETH, my average cost is 1,400, so it's up 200%. Solana is $26, it's up 780. XRP is 400% up. So these are my top 4 bags. These are my 4 biggest bags. And so these are just the 4 that I'm going to focus on right now. These are the 4 that I'm going to focus on right now. And then any of these smaller ones, I won't. Now, this is not my micro caps. These are only my major positions. Okay. I do have other positions in a separate portfolio. I don't know how much I can show. Again, I don't want to show exact dollar amounts and stuff because it does make me a bit uncomfortable, especially from a safety perspective. But yeah, this is just my main portfolio. Again, this doesn't include any of my micro caps, my speculative purchases, my pre-sales, none of that. This is just my main bag. Okay. So with that in mind, I'm just going to focus on Bitcoin, Ethereum, Solana, and XRP for now in terms of specific price buys and sells. So what I want to do really quickly is I want to show you what my current buy and sell targets are for Bitcoin, ETH, XRP, and Solana. All the purchases and sales that I will make will be small to medium, which is like 1 to 5% of my entire bag. And they will get bigger the further in that direction we go. So for example, if Solana starts going down, I'll do some buying, but the lower we go, the more buying I will do in the opposite direction. And hey, guys, can we pull back with the Toshi? Can we pull back with the Toshi conversation? I just feel like no one's interested. It's kind of just getting annoying. But anyway, so here are my current buy levels for Bitcoin, 113.3. Give me 1 second, guys. 113.3 is my first buy level, tiny buy level. The next one is going to be 109.3, 101.7, and 98.3. And I will do bigger purchases the lower it goes. My take profit levels for Bitcoin are as following. 117.7 and 120 are the first 2. These are small take profit levels. The next one is 124.6, which would be like a medium sized one. 129.8 and 136.5. These are 2 of the bigger ones that I would do. Okay. So if we can get up to 129 and 136, I will continue to take some pretty hefty profits out of my Bitcoin positions at these levels. Feel free to just screenshot these if you want to apply them to your own chart, but obviously don't steal my exact strategy. In terms of where I would buy Ethereum, 4,400 is a small purchase, a bit of a bigger purchase at 4,250, bigger purchase at 4,000, some pretty large purchases between 39 and 36.5 because I do think there's a lot of opportunity for this macro golden zone to hold support. In terms of sell levels, I'm going to start muting people talking about Toshi for a little while. I'm just going to warn you, okay? In terms of sell levels where I'm going to take profit on ETH, I am doing some micro take profits on Ethereum because this is a very difficult structure for it to maintain, this ascending structure. So 464, 476, and 488 are 3 small take profit levels that I am going to do. Then I'm going to do a bigger take profit at 52.15, which is a strong Fibonacci extension zone, if we can make it that high. Okay, so that's kind of where I'm going to be doing a little bit of selling for my Ethereum bags. Again, feel free to screenshot that. Okay, going a little bit down. Solana's buy levels. I actually do have quite a bit of buy levels set in for Solana because I do think Solana is going to try to make a run to $400. So I want to catch this dip. 218, 200, and 192 are all small buy levels that I have. 175 is a medium buy level. 155 is a big buy level, actually. So that's kind of where I'm going to be doing some buying. Feel free to screenshot that. Solana sell levels, this is where I'll take profits off the table. 264, 296 are going to be like small to medium sized take profit levels. $350, which is psychological resistance, will be a pretty large take profit level. $407 will be a really big take profit level, to the point where I may close about 30 to 40% of my entire Solana bag. And remember, my bag of Solana is currently up 780%. So if I'm at $400, we're getting extremely close to 1,213% in gains. And I would just want to lock that in. Those are generational gains that I would be able to rotate into real estate and other things like that, of course. And then last but not least, XRP. XRP, these are my buy levels. 2.8, 2.7 are small. 2.69 is like small to medium. 2.5 is actually a pretty big buy level that I would be willing to reinvest some XRP back into. Now, I hope you guys do understand, with these buy levels, I'm simply just reinvesting some profit that I took. As you all know, I have been pretty dramatically taking profits off of things like Solana and XRP and Ethereum, especially over the last couple months. And so I'm just taking some of the profit that I took and reinvesting it back in at these levels to try to recompound some of those gains. Okay. And then my sell levels for XRP are two small ones at 3.4 and 3.6, or 3.39 and 3.67. These are two small take profit levels that I have. I then have 3.97, where I'll do a pretty sizable one, maybe like 3 or 4% of my portfolio. 4.4, which is a Fibonacci extension high. I would be doing like a medium to large one, which could be anywhere from 5 to 10% of my total bag. Okay, so those are my specific sell levels for XRP, where I will be taking some profits off the table, especially considering we were dollar cost averaging in this descending structure here. Okay, so as you can see, my game plan is not to try to guess which so my game plan is to not try to guess whether the market's going to go up or down. My game plan is to accept that I don't know what it's going to do. We are back in a manipulative phase. In the short to midterm, I don't know what it's going to do. Over the long term, I'm very confident it's going to go up because of all of this. Okay. And so in the short to midterm, we're simply at the mercy of the lizard people. It's literally whatever they want to do. If they want to drop it, they'll drop it. If they want to pump it, they'll pump it. There's nothing we can do to control it. There's no point in even trying to guess. It's literally just a game of chance. And because of that, what I know is that lizard people will always move this market in the direction that's going to hurt the most amount of people in the short term, then usually reverse it. That's like the lizard MO at this point. And so because of that, I just contrarian trade. If the market starts falling, I buy. If it starts pumping, I sell. And I do it over and over and over again. I've done this all year. Guys, we have generated more profit this year than I genuinely believe most other communities here on YouTube and over on X, because we have consistently gone against the grain. And we've done this for years. I mean, I'm not trying to toot my horn, but look at these damn entries. Like, we've been doing this. I don't just talk it. I don't just say I do it. I do it. And that's why I have Bitcoin at 33,000. That's why I have ETH at 1450. Guys, we're talking hundreds of thousands of dollars in positions. These aren't little positions. Like 33,000, 1450. Solana, I bought this thing at $19, right? Like, and my average cost is 27 because I was buying at $200. XRP is at 60 cents. Stellar, 21 cents. BNB at $300. I mean, that bad boy's up over 200% now. Like, you have to just be willing to say, I don't give a fuck what this market throws at me. I am going to get in there and I'm going to go against the grain, and I'm going to do what most people are not willing to do. Most people are not willing at all to go against the grain. And if you're willing to, you are going to win at some point, whether it's short term, midterm, or long term. I don't know, but you will eventually win. And you have to say, fuck this market. I'm going to do what I know I'm supposed to do, and I'm going to go against the grain. And what is the general premise of investing? Think about it. And you know what's crazy is I'm telling you something that you should already know. What's the general principle of investing? Buy things when they're low, sell things when they're high. And literally what I'm telling you right now is to just do that. And it's so stupid that I even have to say it. But truth be told, most people don't do that. Most people are not willing to take that leap of faith, to trust themselves, say, fuck this shit. I'm going to do what I know I'm supposed to do. I'm going to buy it even when I'm scared. And I'm going to sell it when everyone's all excited, because history shows if you do that, you win. Simple as that. And so that's what I'm going to do. And so those are my specific buy targets for my big bags. Okay. My smaller bags, I'm going to go in. And look, I actually want to show you the position sizes of my bags. 1 second. I just don't know how to do this. Give me 1 sec. I'm trying to see if there's a way that I can show you guys how much of my total portfolio each one of these assets is. No, it's not going to let me. But, oh, I posted on my Instagram story. Hold on, maybe it's still there. 1 second. No, it's also not there. It's fine. I'll show you guys that in a little while. But anyway, so that's kind of my game plan for my big bags. Again, for my smaller bags. So whenever I say smaller bags, I'm talking like Stellar, BNB, Swede, Chainlink. All I'm doing is looking at the 4-hour RSI. So what I'll do is I'll go to my chart. I'll click 4-hour. And I'm going to head over to like XLM. And I'll say this. If XLM 4-hour RSI goes below 30, I'm going to start buying. If XLM's 4-hour RSI goes over 70, I'm going to start selling. And it'll be little clips, 1 to 3% or something like that. but they will be decent sized clips, right? And I'll do that for XLM. I'll do it for HBAR. I'll do it, I'm going to probably add a little more CASPA to my bag. I'm going to do it for ADA, Pepe, SHIB, right? It's a very simple game that I'm playing here. It's not as specific because, again, I don't have time to be focusing on each one of these, looking for specific buy targets. It's just a little bit emotionally overwhelming to try to do that during a time like this. It's easier to just look at like your top four, right? I call it the basics in my portfolio: Bitcoin, ETH, Solana, XRP, basics. And, I'll just have specific buy targets for them. But the rest I'll just say, okay, SWIN oversold or overbought? Nope. All right, not doing nothing. XLM? Nope. HBAR? Nope. ICP? Nope. ADA? Nope. Okay, cool. Well, they're all neutral. So guess what? I'm neutral. I'm not going to do anything. And I'm just playing the game. Okay. And that's the best thing that you can do, in my opinion, is just play the game, allow for the oversold or the overbought, and make your decisions from there. Truth be told, most people who are looking at the market right now and who are upset, you're just being a fucking crybaby. Like, I'm not going to lie. And like, I know that's a very rude thing to say, but truth be told, you're being a fucking crybaby and you need to zoom out and actually look at what's happening right now, right? Because look at like a Bitcoin, right? If we're talking about Bitcoin specifically, altcoins are different. Like, some altcoins have actually not performed well. But if we're talking about Bitcoin literally made a run from April this year to August of this year. So just last month, August 15th. So just last month, less than exactly 1 month ago, basically, made an absolutely crazy run from $74,000 all the way up to $125,000. It's pulled back. It's trying to flip that previous all-time high, this level of liquidity, of resistance, trying to flip it into support, and it's trying to use that support to continue upwards. Bitcoin is making a very good move. And if you just zoom out, you can see that Bitcoin's making a good move. If you look at Ethereum, Ethereum's making a good move. What is ETH trying to do? ETH is literally knocking on the door of breaking through its previous all-time high. And sure, it's maybe taking some time. Maybe it's, been a month that we've been sitting right here. But truth be told, it's not going to be easy. Who the fuck told you it was going to be easy? This is a massive level of resistance that ETH is trying to break through. And sure, it's struggling a little bit. Sure, it may need to pull back a little bit, but it's showing all the signs that at some point it's going to run through that. And when the time comes, we're going to make gains. When you look at Solana just broke through the macro golden zone. And what's it doing? It's struggling to break above this massive resistance zone. And is that a bad thing? No, it's a normal thing, because the longer Solana gives us this push, the more it'll diminish that bearish power coming off that resistance. And when it breaks through, it's going to fly. We're going to see Solana hit $400 one day, maybe $600 one day. Stop bitching and just wait, truth be told. You look at something like XRP. What's XRP doing? It's struggling. It's at a previous point of resistance. Look back further. Previous point of resistance from way back here, right? And so, yeah, right, that one right there. So what's XRP doing? It's sitting directly under a resistance zone, just trying to break above it. And it's taking some time, but what is going to get us above it, guys? We need buying power. We need the macro environment to be in a better spot. We need the economy to be in a better spot. We need retail to be in a better spot. The lizard people are going to continue to manipulate things until they want to, so we need to let them ease up a little bit, right? We are not in an environment right now that is suitable for euphoric growth. We are in an environment that is suitable for slow, steady gains, and that is exactly what we're getting. This market has been setting itself up perfectly for what could be an outstanding run, an outstanding pump, and some absolutely juicy gains. And truth be told, I'm not talking to anyone who just got to crypto in the last year, okay? But those of you who have been here for the last couple years, I'm not trying to flex, but I'm just being honest. Truth be told, if you were here in the last bull market, in the last bear market, guys, you're up hundreds of percentages. If you just bought and held, you're up hundreds of percentages. So if this isn't good enough for you, you're fucking delusional. It's just the truth. And I know I'm being a little bit rude right now. And trust me, I would sound a little bit different if my, how to explain it? Like, if my voice wasn't all messed up, I would sound a little bit nicer when the way I'm saying this. So please take it with a grain of salt, okay? Take it with a grain of salt. I'm not trying to be mean, but you're fucking delusional. Like, if you're up 200, 500, 700, 400%, whatever it may be, and that's not good enough for you, you're being delusional. It takes so long to accomplish that. Listen, I come from a more traditional background in the sense that I've spent the first few years of my investment journey in the stock market. The shitty stock market averages 10 to 15% gains year over year over year. You know how fucking long it would take you to get a 300% gain in the stock market? A long time. So if that's not good enough for you, you need to go to the goddamn blackjack table. You can make 100% gain there fast, or you can lose everything if that's the game you want to play. But truth be told, the crypto market has set up beautifully. It's done a great job. It's made some small, steady gains in an environment that is not suitable for growth. This year has been ass, bro. We have all this bullshit going on in politics, all this bullshit going on geopolitically. There's so much going on right now that is directly hurting the crypto market, making it almost damn near impossible for growth, making it impossible for this market to flourish. And what has it done? It has pushed up consistently. It's given us gains. Some altcoins have performed like absolute dog shit. I'm not speaking about those ones, but if we're talking about the crypto market as a whole, it has made a fantastic run towards the upside. It slowly inches its way upwards. Every time it pumps, it might dump, but it dumps less than it pumps. And it slowly climbs its way up. And when the time comes that it is suitable for growth, that the jet fuel is poured on this market, when the gas is ignited and everything starts to truthfully turn, whenever Bitcoin's at 150K, when ETH is at 60K, when Solana's at, or 6K, when Solana's at $400, when XRP, pushes to $6, $7, $8, however long it may take, all this bitching you're doing right now, you will have forgot about it. You'll be proud of yourself for sticking through the fucking bullshit. Just like I did in 2017, just like I did in 2022, you'll be proud of yourself. But truth be told, this bullshit we're seeing in the crypto market is nothing compared to the bullshit that we've seen previously. And anyone who was there went through it before. This is nothing. Bitcoin being at 115,000 is enough to make you complain. For Bitcoin to fall $300 and you guys, some of you to be in the chat talking about, oh, the market's dumping. No, it's not fucking dumping. Of course it's not. Of course it's not dumping. You're in the pursuit of some crazy, ridiculous shit because you watch YouTube all day, seeing these 22-year-olds who made $1 million off meme coins when they didn't. They just fucking rug pulled all of their followers. You're trying to say, oh, I want to be like them. I want to make $1 million. Guess what, motherfucker? You're not going to make $1 million today. You're not going to make $1 million tomorrow. It is a slow, consistent process. You have to be in the pursuit of progress and growth. It is a journey. It's not an immediate teleportation to a destination that doesn't even truly exist. You have to lock the fuck in and be willing and understand that it's hard. This shit is hard. It's boring. It sucks. But if you stick to your plan, if you give yourself time, and if you do not fold to the fuckery that's going to be thrown at you by the market, then you are going to win over time. And interest rates being cut, a reduction in all the bullshit, a little bit more clarity being provided to the market, guess what? That's going to make it easier for us to make gains. So what we've seen today will make it easier for us to make gains in the future, not harder. And if you're bitching because Bitcoin just not at 125K, you need to check the fuck out. You need to take a step, go touch some grass, and realize you're being delusional, and you need to change your perspective, because that perspective that has you upset right now is the perspective that'll make you sell out this market right before Bitcoin gives you generational gains that could have changed your life forever. So lock the fuck in and get your shit together. Simple as that. This whole, like some people in the chat who are getting all upset because Bitcoin's at 115, lock the fuck in. Simple as that. Simple as that. I know I might sound a little mad. Trust me, I would sound different if I didn't have an infection going on, but it's actually just ridiculous. So anyway, I don't know why I just got on your ass. My bad. I didn't mean it. I hope I didn't hurt your feelings, but lock it. Don't care. Anyway. So what am I doing? I'm sticking to the plan, guys. Let me just screenshot them. Go for the screenshots one more time. Here we go. So Bitcoin buy levels, Bitcoin sell levels, Ethereum buy levels, Ethereum sell levels, Solana buy levels, Solana sell levels, XRP buy levels, XRP sell levels. Okay, that's my game plan. And again, for my smaller bags, I'm just going to wait to see if they hit oversold or overbought on the 4-hour RSI, and I'm going to go in and do small buys or small sells. Okay, so after the stream, either today or tomorrow on my YouTube channel, I'm going to make a full video on my main channel where I talk about like this strategy, and I basically just repeat myself. Like what I said today, I'm going to put it as a YouTube video so you guys can go back in and you can watch it and you can have access to it. So don't feel like you have to scroll through an hour and 50 minutes or whatever this has been. You guys will have access to it, and I'll kind of talk a little bit more in depth about the interest rate situation. But all in all, that's where we're at. A couple things that I do want to shout out really quickly, guys. If you do want more content from me, I do post over on my Instagram every single day. Like random stuff, like whether it's personal life stuff, whether it's the fighting career, whether it's going to Dubai or whatever, just random shit. Feel free to follow me there. If you go to the analysis tab, you're also going to see me posting daily analysis on all your favorite altcoins. Don't forget, you can go get up to $10,000 in bonuses on BTCC. I did just do an interview over on the Fluence podcast, which I will link down in the description below. Let me go actually add that in now. So if you give the description a refresh in a second here, I know a lot of you have asked me time and time again, like what's my story and kind of where I'm at and all this stuff. They did go ahead and interview me over on the Fluence podcast. And I told my story from start to finish on everything, basically. So if you want to learn more, I guess, about me and my journey and, what I've gone through to get here, feel free to go watch that. And then last but not least, I guess that was last but not least. So yeah, feel free to go check that out. Guys, I probably just wrecked my voice. I'm not going to lie. So I am going to take a little bit of time. I'm going to do one more video, maybe a little bit later today, and then we're going to call it a day. We'll see how my voice is holding up tomorrow. But all in all, listen, I know I might be an asshole sometimes, and I might just kind of be ruthless and a bit of a dick. But truth be told, I'm only going to tell you the things I genuinely believe that you need to hear. And if you don't like that, if you feel like it's not for you, go find someone else to watch. I love you. I appreciate your support, but this isn't a channel where I'm going to sugarcoat. I'm not going to just adapt to your bias. If you want me to say up, I'm not going to say up. No, I'll tell you down, because historically when I say, like, if the market's falling and I say I'm buying, people always, oh, Tyler, you're wrong. And then history speaks for its goddamn self, right? Look at the community that we've built. Look at the gains in the portfolios of most of the people in this community. It's because we go against the grain, and I'm going to continue to do that. So no, I'm not going to sit here. I'm not going to make you feel good. I'm not going to lie to you and tell you a bunch of bullshit. Go find somebody else to watch that. I don't care if I get less views. I don't care if I get less subscribers. Couldn't give a fuck less. What I care about is that those of you who watch me and genuinely support me are put in positions where you can not only be given the things that can help you grow, but you truthfully learn the things that help you grow, and you can pass those down to your friends, to your family, and further generations, so that we can actually make a motherfucking impact from this world of Web3 that's given us such a great opportunity. So that's where we're at. And so I'm not going to sit here and lie. I'm not going to sugarcoat. I'm not going to pretend. So if that's what you don't like, it is what it is. My YouTube videos are much more family friendly, and you can watch the full videos in front of your kids, but on live streams, I get a bit unhinged, especially the longer I go. Okay. And so with that in mind, guys, I love you, each and every one of you. Listen, if you're watching this right now, after the year we've been through, you're already ahead. Let's be real. You're already ahead. Most people have given up. Most people let these stupid fucking lizard people just absolutely kill them off. You're ahead. You're still here. You're figuring it out. And even if you're down, it does not matter. Just trust me. Give it time, and you won't be. Give it enough time in your bags. If they're in good things like Bitcoin or Solana or whatever, you're going to see gains. I promise you, you're going to. You just have to give it time. And so if you are still here, just stay here. Stick around. I'm not talking about on my YouTube channel. I don't give a fuck. In crypto in general, stick around and growth will be had. I'm telling you. And if I'm wrong, I'm going down with a 7-figure portfolio with me. So that's the bet I'm willing to take. Okay. And so with that in mind, just stick around, keep showing up, keep putting in the work, keep putting in the hours, keep watching the videos, keep learning, keep growing, keep getting better. I'm going to go keep trying to get this voice back on track. I'll see you all in the next one. Bye.